This week has been very hard for the big FANG stocks. Meta crashing over 20%, Microsoft down big, Alphabet down big, and now also Amazon down big. In this video, we will take the time to look at the Q3 results and see if it's an overreaction or if the big drop is well deserved. So first of all, we can see that net sales increased by 15% to about 127 billion in just one quarter, which is an insane amount of revenue. But we all know Amazon's business isn't operating at a very high margin. We can see the sales in North America increased by 20%. International segment sales decreased 5% year over year. But we have to say they have to face a lot of headwinds because of currency exchanges. And we can see it would have increased 12%. And right now it's unfavorable. When it comes to next year's earnings results, it will be favorable. And we can also see AWS, the sales increased 27% year over year to 20.5 billion and 28% excluding changes in foreign exchange rates. That's something I don't really like to see because, as we all know, AWS is the most profitable part of Amazon. And we have seen Microsoft's Azure still growing strong with about 35%, I think, and Alphabet growing even stronger because, of course, their cloud business is still a little bit smaller. But I was hoping for growth rates a little bit above 30% year over year. We will also see that there's a problem with the AWS segment when we're going to take a look at the expenses. But first of all, the operating income, we can see it decreased to 2.5 billion in the third quarter. That's mainly because the e-commerce business of Amazon is operating at a loss. North America's operating loss $0.4 billion, the international segment $2.5 billion. I remember one year ago, it seemed like they were able to operate the international segment with profits and that they could use that operating leverage. But right now they are facing a lot of challenges. AWS, it grew slightly, now it's 5.4 billion and it was 4.9 billion in the third quarter 2021. Net income also decreased to $2.9 billion. And we can see this leaves us with a crazy high price to earnings ratio right now. But I also don't like to value Amazon on a price to earnings basis. I think we need a price to sales ratio or to take a look at the free cash flow of the company, which is exactly what I did in my Amazon analysis. And I highly suggest that you take a look at this analysis where I value Amazon based on the free cash flow of the company in future years and decide if it's a buy right now. If you haven't seen it, I highly recommend you check it out. I will leave a comment down below. The operating cash flow decreased 27% to $39 billion. We still have a positive operating cash flow, which is something that I like to see. But free cash flow is currently negative for the trailing 12 months. Let's also take a look at the highlights of the company. We can see they are still obsessed over the customer experience. And they just launched The Lord of the Rings of Power, with over 25 million global viewers on its first day. Currently over 100 million viewers, which is an insane number. They're also getting into football right now and into soccer, which is something I like to see. In an interview I have seen with Andy Jassy, he said that he wants to make Amazon Prime such a good deal that it would be stupid not to have Prime. And I really think that Prime is such a good product. It just makes sense to use it. Right now they rolled out Venmo as a new payment option in the US, which could also be very good for PayPal. They have new partnerships and commitments with AWS. And something that is also very important, they will increase the wage to a pay of more than $19 per hour. This will lead to even higher expenses in the next year. Right here they say that it will cost another $1 billion in pay increases. And although they say that they announced plans to hire 150,000 people for open seasonal full-time and part-time roles across its operations network in the US to help deliver for customers during the holidays, they are currently trying to reduce the staff. So this is something they're just doing for the holiday season where they need a little bit more workers. Now let's take a look at one thing where I think personally that this made the stock drop so much. It's the financial guidance for the fourth quarter. The net sales are expected to be between 140 billion and 148 billion, which is a growth of only 2% to about 8%. Also a very wide range. And they expect the operating income to be between $0 and $4 billion, also a very wide range. And let's compare that to the fourth quarter last year. It was $3.5 billion, which doesn't look good. And especially right now, the stock market has shown us that they don't like bad future outlooks. Here we can see at least they had a positive net income, but a little bit less than in 2021. I was actually surprised that revenue grew so strong, but we can also see that the expenses grew very strong. Net product sales up from 54 billion to 59 billion. Net service sales up from 55 billion to 67 billion. We can see the total net sales grew very strongly in the past 3 months. The operating expenses also up very big. Cost of sales, look at this, that's a difference of $8 billion. Fulfillment, I was actually surprised to see that it's just a difference of $2 billion and maybe a 10% increase. Technology and content up $5 billion. Even sales and marketing up $3 billion. General and administrative up a little bit less than $1 billion. And the total operating expenses up nearly $20 billion. And if your revenue goes up $70 billion and the operating expenses $20 billion, this doesn't look good. This doesn't look good at all. Let's also take a look at the segment information. We can see the net sales in North America grew $13 billion. Operating expenses up $15 billion, so operating at a loss. International, the net sales are even down. I don't really know how this happened. But of course, as we said earlier, it's because of the currency exchange. Operating expenses, at least those stayed flat, which is something that I like to see. But they have to get at least North America positive. They have to generate some sort of income with their e-commerce segment. Because if something happens to AWS, and this is the only part of the business that is making a profit, then they have a huge problem. And we can also see net sales at AWS up $4 billion, but the operating expenses also up nearly $4 billion and growing very strong. Of course, they have to pay a lot for energy right now, especially in Europe. So I hope this is a one-time effect. Maybe we will see this for a few quarters, but I believe this will get better. We can also see in 2021, AWS grew 39%, and right now in 2022, only up 27%. And even if we exclude constant currency exchange, it was 28%. So we see there's a decrease in growth rates. It's good to see that the online stores finally start to accelerate their growth a little bit. They have stayed flat for over a year now. The physical stores, I really like this segment of Amazon. They keep growing in the low double digits. I think it's a very good strategy for the company to diversify their business. Third-party sellers up 23%, also very good to see. Subscription services, which includes Amazon Prime, up 14%. Advertising services growing very strong despite the economic headwinds we have just seen with Snapchat's earnings, Alphabet's earnings, Meta's earnings. But Amazon's advertising service is very strong, and I really like this segment because it's operating at a high margin. As I said in my analysis, I really care about subscription services, I care about the advertising services and AWS, because as those grow in the double digits and outgrow the online stores, the margin of Amazon gets higher over time, because this is the part where Amazon operates at a very low margin. The advertising service has a very high margin and AWS also has a very high margin. So I like to see those parts grow a little bit stronger and pushing the margin of Amazon higher. So now that we have seen Amazon's quarterly results, we have to answer the question, is the big drop in the stock, is it justified? And I personally think it's an overreaction. Yes, the outlook wasn't that good, and it's especially because they gave such a wide range. And what does it mean having an operating income of $0 and $4 billion? That's such a high difference, and I didn't like to see AWS growth go below 30%. But overall, I think the quarterly earnings were pretty good, and we have seen that every segment of the business kept growing. We have seen strong growth in the subscription services and in the advertising services, and still in AWS. There's a good reason for higher expenses with AWS because of the energy costs in Europe. They are already trying to cut costs. They want to reduce the number of employees, which is something that they are already doing. And I like to see that they are cutting costs, but this is something that takes a little bit of time. And right now they are facing a lot of headwinds, currency wise and economical. But I think all those headwinds that we are facing right now will be tailwinds in the next year. So will the stock price go even lower? Maybe. Maybe the next month will be very hard for Amazon. But when it comes to a long-term perspective, I think right now is a great time to take a deeper look at Amazon and to ask yourself if you want to be a long-term owner of Amazon.